Our next guest sees a lot of two-way risk in the market. Mike Wilson is Morgan Stanley's chief U.S. equity strategist and CIO. Mike, it's always good to see you.
Thanks for having me.
Two-way risk sounds like markets up, markets down. What do you mean by that?
Well, it's not getting any easier. Okay, let's put it that way. I mean, I think the first half of this year was, fairly simple if you just were bearish and kind of held that position. And then, we've had two major, tactical rallies since June, the first one, and then, of course, one in October. This one actually has better breadth, which is kind of interesting. And so I do think we're closer to the end. I mean, we don't know when the Fed's going to pause. We think it's January. We think they do 50 in December, 25 in January, and that's it. Okay, that's ahead of where the market is. And the market's trying to pre-trade that, kind of like it did this summer. Now, we thought it was premature this summer to get in front of that. This time, we actually think there's validity to that. The question is, what are you going to pay for this thing if you think earnings are going to be really disappointing next year, which is our core view? So, we're trying to have our cake and eat it too. We like to do that, right? So we're having a tactical rally now. I kind of agree with Steve. We probably got some upward bias into year end, but ultimately the bear market's not over, and we got significantly lower lows if our earnings forecast is correct.
Yeah, so 2023, your price targets are out. 3,600 is your bear case, 3,900 is the base, and 4,200 is the bull case. What's the rate expectation backdrop to these cases?
Yeah, so it's probably somewhere between 275.3 if it's a recession to maybe 4.25 if there's a reacceleration in the back half of the year. I'd probably split the difference. I'd probably say it's 3.25, something like that. Look, to me, it's not about the year-end targets. It's about the path. Right? I mean, nobody cares about what's going to happen in 12 months. They need to deal with the next 3 to 6 months. And that's where we actually think there's significant downside. So while 3,900 sounds like, that sounds like a really boring 6 months. No, this is going to be challenging.
It's a wild ride.
It's going to be a wild ride. And there's going to be a lot to do. I'd say the best thing I can say is, the breadth's getting better. The average stock is doing better than the index. And there's going to be probably stock opportunities going forward as opposed to just trading the index.
I think it was October 14th on a Friday is when you came out tactically bullish, 15% rally. It's exactly what happened. I mean, so you nailed that. But 3,600 as a bear case does not seem catastrophic to me, given the backdrop that we've talked about for a while. So I guess what are your earnings number, then what multiple putting on the back of that?
Yeah, but remember, 3,600 is year-end 2023. So our bear case path is 3,000. So, and look, the range we've given people is you should expect a S&P between 3,000 and 3,300 sometime in probably the first 4 months of the year. That's when we think the deceleration on the revisions on the earnings side will kind of reach its crescendo.
I'm sorry to interrupt. 3,000 to 3,300 in the first 4 months of the year. In which case? In any case?
That's the range. I mean, we can't be that precise.
Right. But still.
Yeah, that's a big drop.
That's a big drop.
Correct.
Yeah. Okay.
And that will be driven really by the earnings revisions to the downside, which is the second half of our thesis for this year, which is the ICE part of the fire and ice.
So, Mike, you mentioned that the average stock is doing better than the index. And what have we seen? We saw the 5 largest stocks in the S&P 500 and the NASDAQ all guide down for the current quarter, right? And so they've acted pretty poorly. It's Microsoft, Apple, Google, Amazon, Tesla. So do you think there's risk the fact that the market rally has broadened out this time compared to the one in the summer, like you just mentioned, but this is not going to be a one-quarter phenomenon? You're just saying you're expecting revisions, downside revisions in estimates to speed up here. Does that really cause a flush in a way? If the major names lead to the downside and then weak hands and some of that other breadth starts coming out, we could get to your 3,300 pretty quickly in the new year.
That's right. I mean, look, we think most of the damage will happen in these bigger companies, not just tech, by the way. It could be consumer, it could be industrial. Remember, when those stocks had a tough time in October, the money went into these other areas. So part of that, rally has been driven just by repositioning from the money moving. That doesn't mean it's safe, okay? So I want to be perfectly clear. We're still pretty bearish on the next 6 months. It's our job to call these tactical rallies. We got this one right. We don't always do that. I still think this tactical rally has legs into year end, notwithstanding all the noise we're going to get in the next 2 weeks, simply because of the liquidity at year end and people chasing, and we have to deal with that. So this is not a time to sell everything and run for the hills, because that's probably not until the earnings come down in January, February.
Well, it's interesting. So, but you do seem like you're saying by March or April or May of next year, the bottom is in.
I think so, yeah.
And what tells you the bottom is in? Is it the revision story, or is it really the combination of the Fed has signaled? So
there's really two things, Tim. I mean, I think you have to really take a view on. The first is, okay, first, are we going to get those revisions? Are you going to get price to give you a fat pitch? Because that's the one thing that hasn't happened yet this year. Even though June, prices got low, and October they got low, the equity risk premium never really came in, right? It was all about rates. Now you need the equity risk premium to kind of blow out to tell you that there's a recession risk or a real earnings, degradation. But to get bullish, you then have to take a view, okay, are we in a 70s stagflation type scenario, which you're not going to get bullish? Or are you in the 1940s boom bust scenario that we've been kind of talking about, where there's a bust next year in earnings, but then 24, there's actually a reacceleration in earnings. Okay, and that's our core view. So the market will figure that out, we think, sometime in the spring, maybe early summer, and there'll be a good second half.
Mike, thank you for coming by. Good
You
to
bet.
see you. Mike Wilson, Morgan Stanley. Grasso, you're with Mike Wilson in terms of the call for a face ripping. That's your term. You're in rally, but how about for next year?
Yeah, so I'm on the same page with him. I think you're going to get that tactical rally going into year end. And I do believe the market will bottom after the first quarter because the Fed most likely, history has shown that after they start on a rate rising period, they start to cut. And that coincides with probably mid-year. So first quarter, bottom, market rallies from there.
I mean, Mike's call is much more tactical than what we typically get from an equity strategist, for sure.
It's the greatest trading market of all time, though, as we've said, and good for him. Because he's called a lot of these turns, and a lot of them have been based upon extreme sentiment, extreme moves. But the thing he's saying that's different here is that the equity downgrades and revisions are going to truly give the market a chance to estimate where these companies have gone bad.
Yeah, and we haven't seen the beginning. I mean, we've just seen the beginning. We're not going to see the worst of it till next year.
Yeah, no, and I think it makes sense. If you think of I think in the post-war period, the average decline, the average bear market lasts about a year. It goes down about 30, 35% or something like that. So the way Mike's seeing is that once we get to the meat of the downside revisions, 2023 estimates come down, the companies guide down, sentiment is downright horrible. It feels kind of scary when you're going to have the 10-year yield likely going down at the same time the stock market is making new lows. At some point, it's probably down in that 3,300, 3,400 range, round tripping the entire move to the pre-pandemic highs in the S&P 500, where it's probably close to a bottom. Because I don't think any of us are sitting on the table here and think that we are on a 2008 or a 2001 sort of moment here. We just don't have the leverage in the system. They just don't have the sort of risk unless there's something totally wacky that happens.
Well, the cycles I think move faster. So he was talking about stagflation and where we were in the 70s. I think the velocity of markets is so different today, but the proliferation of information, the efficiency of markets, and I think this is moving faster, even though this is the kind of an inflation bear market tends to play out significantly longer than a traditional bear market.
We got some breaking news here on Horizon Therapeutics. Shares jumping.